Good day, ladies and gentlemen, and a very warm welcome to the Alkem Laboratories Q1 FY23 earnings conference call hosted by Motilal Oswal Financial Services Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. I now hand the conference over to Mr. Tushar Manudhane from Motilal Oswal Financial Services. Thank you, and over to you, Tushar.
Thanks, Ali. Welcome to 1Q FY23 earnings call of Alkem Laboratories. From the management side, we have Mr. Sandeep Singh, Managing Director, Mr. Rajesh Dubey, Chief Financial Officer, Mr. Amit Ghare, President International Business, Mr. Yogesh Kaushal, President Chronic Division, and Amit from Investor Relations. Thank you, Amit, for opening remarks.
Thank you, Tushar. Good evening, everyone, and thank you for joining us today for Alkem Laboratories Q1 FY23 earnings call. Earlier during the day, we have released our financial results and investor presentation, and the same are also posted on our website. Hope you have had a chance to look at it. To discuss the business performance and outlook going forward, we have on this call the senior management team of Alkem. Before I proceed with this call, I would like to remind everyone that this call is being recorded and the call transcript will be made available on our website as well. I would also like to add that today's discussion may include forward-looking statements, and the same must be viewed in conjunction with the risks that our business faces. After the end of this call, if any of your queries remain unanswered, please feel free to get in touch with me. With this, I would like to hand over the call to Mr. Sandeep Singh to present the key highlights of the quarter gone by and strategy going forward. Over to you, Sandeep.
Thank you, Amit. Good evening to all of you, and thank you for joining us today for a quarter 1 FY23 earnings call. I would briefly take you through the key operational and financial highlights of the quarter. Total operating revenues for the quarter declined by 5.7% year-on-year, Ebitda margin coming in at 7.9%, and net profits after tax at 128 crores. We continue to maintain strong net cash position of 950 crores. Talking about our India business, which declined 6.7% year-on-year during the quarter, this was due to huge base effect of last year. Adjusted for COVID base impact, the company has delivered reasonably good performance in domestic sales, led by contribution from new product introductions, price improvements. Our CAGR over the last 3 years is 13.4% for domestic business. We continue to outperform in the domestic market, and as per secondary sales data by IQVIA, the company sales remain flat year-on-year compared to a decline of 1.8% for the Indian pharma market. This outperformance is driven by a leadership position in acute therapy areas like anti-infectives and gastrointestinal. Our chronic business continues to significantly outperform the market and has been gaining market share and rankings. Our growth rate in derma and anti-diabetic during the quarter is significantly higher than the market. We have gained 4 ranks in anti-diabetic and 1 rank in derma therapy. Now coming to our international business. US business reported a sequential growth of 2.7% with year-on-year decline of 7.9%. The performance in US market continues to be impacted by a higher price erosion. During the quarter, we filed 3 ANDAs with the US FDA and received 4 approvals, including 1 tentative approval. Apart from US, our other international markets delivered a year-on-year growth of 9.6%, with good all-round performance from the Australian market. Coming to our progress in the biosimilar segment, we have launched 3 products in domestic market last year, and we are seeing very encouraging response on these products. We expect to add a few more products to our basket in the financial year, which makes our biosimilars franchisee very promising in the domestic market. We have also signed deals in the CDMO space with a couple of international companies and few Indian players. In coming years, our biosimilar franchisee will be one of the future growth engine for Alkem. Coming to regulatory inspection conducted by US FDA during the quarter, St. Louis facility was inspected in June 2022, and post the inspection we received 3 observations. We have already replied to the US FDA with corrective and preventive plan to resolve these observations. Apart from St. Louis, our Indore facility was also inspected by FDA. This was a pre-approval inspection, and we received 1 observation after the inspection, which we have also replied. Our Teluja Bioequivalence Center was inspected by US FDA in April, and the inspection was successfully closed without any observations. All other manufacturing facilities supplying to the US market have an EIR as on date. To conclude, we have started the year with market-beating performance in domestic markets as per IQVIA, and we continue to outperform the market in our domestic franchisee. Our margin for the quarter was impacted by headwinds from spike in material cost, higher marketing expense and distribution expense, and the price erosion in US. We would continue to drive operational efficiency through productivity improvements and various streams of cost optimization that we are running in the company. Thank you very much. With this, I would like to open the floor for questions and answers. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kunal Dharmesh from Macquarie Capital. Please go ahead.
Hi, thank you for taking my question. First one on the US, how many products are we planning to launch in the US for FY23, and any meaningful product we should be aware of for FY23-24?
We are expecting to launch about between 8 to 10 products, probably 10 during the fiscal year. And meaningful, we don't want to take a shot right now in terms of answering that question, but there are some shared exclusivities that we have already launched, and we are looking forward to a few others as well. Time will tell how successful we are in those.
Sure. And a second question is on the other expenses. What is driving the other expenses on sequential basis? I think it's up by about 100 crore.
See, you are asking from sequential quarter.
Yeah, sequential perspective. Yes.
So generally, our other expense is around 23 to 24%, and this time it is higher, and in fact it is somewhere close to 29%. And
what is driving it, sir?
And mainly it is on account of some additional marketing expenditure, some additional traveling expenditure because of normalization. So sales and distribution expense also, it was on the higher side, particularly for our export freight. And then we have some forex loss which also has gone into it.
Can you quantify the, maybe the kind of one-offs like forex loss and maybe higher freight expenses which might not
we have a low gross margin this quarter. If you can give some more color, any specific, raw material that you're facing pressure, and how are the raw material prices trending, and therefore how should we think about gross margins going forward?
Yeah, Sayan, Rajesh here.
Yes, sir.
We can see our gross margin from 60% coming down to 57.5%. Basically, yes, you rightly mentioned also material cost, it has impacted. So impact of material cost is around 2.5%. Obviously, expensive raw material we purchase and is consumed in this period. So that is one of the reasons. Second, you ask how prices now it is behaving. So yes, it has started softening, but still I think it has not come back to its original position. So it is in between kind of, but definitely going forward, we'll start getting benefit of this raw material cost. Of course, it is going to soften going forward. Second, as we discussed in US, price deflation, that is another reason, and that also impacted us somewhere close to 2%. But that is offset by favorable mix. So we got better business mix, so that has taken care, and that's the reason 2.5% difference we have.
And just to add to that, he wanted some on specifics. Like cephalosporins have been most impacted by price rise, and we are the number one company there, Sayan, as you know. So therefore, we were kind of impacted by that. Cephalosporins continues to be one of the most impacted raw materials.
Okay, so this is due to the PNG prices, and how are they trending?
They're trending very high. It's historically, I think, lifetime high, I think, in my memory, $40.
And is it possible to quantify, like, how much of, the impact is? I'm just wondering, this raw material which is used to make these cephalosporins, how much in terms of rupees crore, if you can give, and, where we are versus where we were?
We don't have it right now, Sayan, but Amit will get back. He can share it with anybody he wants.
Okay, sure. And any guidance you can give on gross margin going forward?
I think we have already guided our gross margin to 59%, and we remain with that for year. 59%
for the full year?
Yeah.
Okay. And what about Ebitda margins? You had talked about 18% in the previous call. This quarter it has been very low. And also if you can give some color on other expenses, again, it's on a very high side. How should we think about that as well?
Yeah. So, Sayan, I think last time we spoke about, yes, you're right, about 18% EBITDA, but kind of two things which are a little bit, new this quarter, which we have to see how it goes. One is we have out of close to 48 crores to be precise, of currency impact, which we were not very sure last time. So this is out of the blue slightly. And then US price erosion is also slightly more than what we were anticipating. So looks like we could be 100 to 150 basis points lesser than 18% what we thought we'll be doing. And Mr. Dubey, the second part of the answer maybe.
Yeah. So other expenses, I think I have already covered that. And in other expenses, particularly in this quarter, there are few expenditure where preponed it has happened, mainly marketing expense. Then, as I said, traveling expense is on higher side. As selling and distribution, mainly freight expenses, is on higher side, and forex loss is one-off, which managing director just now mentioned, of somewhere close to 48 crores. So, of course, 28.9% other expenses is abnormally on higher side. Traditionally, we have other expenses in the range of 23 to 24%, and by year end, we'll be somewhere closer to that. And,
okay. So
yeah.
23, 24 by end of the year, you're saying? Okay.
Yeah.
Okay. Okay, thanks, and I'll join back with you.
Thank you. The next question is from the line of Yash Tanna from iThought Portfolio Management. Please go ahead.
Hi, good evening, team. Am I audible?
Yes, sir, we can hear you.
Yeah. So, sir, I went through your annual report, and I was just looking at this one line item called sale of services in the revenues. So that has increased from about 7 crores in FY20 to 17 crores in FY21, and it's around 58 crores in FY22. So, what is this exactly pertaining to, and how do we?
What did you say? Sale of position? Can you please repeat? We didn't get it.
So, I was seeing at this line item, sale of services in revenue. That has gone up from 7 crores in FY20 to 58 crores in FY22.
CDMO? In the annual report, Baba. Yeah. Is it CDMO? Yeah. That is CDMO. That is contract services maybe for
Okay.
Yeah.
So that has scaled up pretty well, and so I was just curious to know, could this be like a 100-200 crore kind of a line item going forward? Since it has scaled up pretty, it's still a very smart portion of our revenue, but scaled up pretty well.
Right. So what do you want to hear, sir? I mean, yes, we want to ramp it up, but we really don't know. I mean, whether it can be done in the next 1 or 2 years.
Okay, got it.
We're kind of seeing how the business ramps up.
Sure. Yeah, and the other question has been answered, so thank you.
Thank you. The next question is from the line of Nithya Balasubramanian from Bernstein. Please go ahead.
Yeah, thank you for the opportunity. I just had the one question on trade generics. Is there any update at all or any more visibility you have on the trade margin cap that the government keeps talking about time and again?
Sorry, what exactly is the question?
So is there any update? Have you heard anything new from the government on trade margin cap? Any plans of implementing it? Any timelines? Anything you might have picked up in recent times?
No, we have picked up everything which everyone picks up from the media. We don't know.
Does that concern you? Is that a real threat? How do you think about it?
So I think, see, it does not concern us too much. Of course, it would be a disruption because those rules will apply to everyone. So nobody's going to get any advantage or disadvantage. And we being leaders in it will continue to grow, and we will continue to grow market share. I think the new players would be severely more impacted. And so it doesn't worry me too much. And anyway, we don't worry about things not in our hand. We have a large portion of prescription business. Maybe we'll have a rub-off there as well. So I think we are fine.
All right. Thank you so much and all the best.
Thank you. The next question is from the line of Neha Manpuria from Bank of America. Please go ahead.
Thank you for taking my question. Sandeep, if I were to look at your cost numbers in the quarter, there's been an increase in employee cost and in your SG&A, even adjusting for all the one-offs. I think which you, sir, mentioned is because of sales and promotion. Now, if I were to look at the data that is available for Alkem, our margins have been in the 15 to 17% range, and we've been trying to sort of improve it to 18 plus for some time now. But do you think, given the competitive scenario in India and the investment that that business requires, incrementally it's getting difficult for us to improve margins? What gives you confidence, in the margin guidance that we are, giving for 18+% next year?
I think this year is an anomaly. So this year, of course. geographies or, in the company name. So these are for clinical trials. So they are in early stage, for clinical trial supply. They could be in the chronic space, and, what therapy areas and all that stuff is for. It could be onco, it could be osteo. Yeah.
Okay. So what kind of competition is there in that, like in the Indian space for this CDMO? So like you might have spent a lot for this for marketing. So how long can we expect to monetize?
No, we have spent nothing on marketing. So this is not a marketing game. It's a service industry. You don't require a lot of marketing in CDMO. So.
Okay, sir. My other question is on this dermatology. So for this quarter, we had a solid double-digit growth. So moving forward, what is the strategy to scale up the revenue in dermatology? Because I could see the ranking is kind of not as same as in the other segments. So do you have any particular strategy in dermatology?
Yes, yes, we do. I mean, one is that we are consolidating our current brands. Yeah, there are like antifungals, antihistamines. These are something which we are at a very nascent stage, so a lot need to be done there. Plus, we are also looking at, strengthening our cosmetic portfolio there, particularly face creams and all, your sun cream lotions. So these are some very high volume and high used products. We are still very small there. So one is currently there are some of the therapies where we have a good presence, and some, particularly in cosmetology, we were not so big, and there we are exploring. So I think these two put together, we see a reasonably good growth in next 2 to 3 years time. And beyond that, we will look at some of the maps which are being used in dermatology, which is just shortlisted. So we'll see how do we progress there. But currently, for next 2 to 3 years, we're very clear, and there are a lot of innovations which can be done in dermatology. We should be working on those directions as well.
Okay, sir. Okay. Thank you, sir.
Thank you. The next question is from the line of Sumit Gupta from Motilal Oswal. Please go ahead.
Yeah, hi. Thank you for the opportunity. So my question is on the US business. So first question is the US sales has been stable despite price erosion. So any specific reason to highlight on this aspect? And second question is US sales growth. What is the growth in the constant currency basis?
So the first question is, no, we have degrown compared to last year, year on year. We have not grown, and we are not steady. Sequentially, yes, we have grown. The price erosion has been one of the factors which negatively affected. Volume has been steady, and of course, new products contributed positively, but they could not offset the loss in price essentially. What was your second question? I'm sorry.
Okay, sir. Sales growth in the constant currency basis.
Sales. This is all constant. So what I reported was in dollar terms. So in rupee terms, obviously you've seen what the results announced are.
Okay. And sir, the stable part, I was looking at the sequential only. So that's what.
Oh, you were looking at sequential. Okay. So sequential constant currency basis, we are probably flat.
Okay, sir. And sir, and overall investment in biosimilar, which is expected in FY23-24?
23-24. Next year. Okay.
It's within the 6%, right, overall? So.
Yeah, overall R&D, including biosimilars and small molecules, is 6%. Yeah. You want to know, what do you want to know, sir?
Sir, regarding the overall investment in the biosimilars business, so how, what kind of investment can we see in the numbers also, in the value terms?
Yeah, specifically, we can't, I'm not sure they can answer, but I can tell you, yes, biosimilars investments will be going up compared to this year, but overall we'll manage in the guidance we have given of 6% R&D of revenue. We'll not be spending more than that.
Okay, sir. Thank you.
Thank you, Chief. Thank you.
Thank you. The next question is from the line of Sayan Mukherjee from Nomura. Please go ahead.
Yeah, thanks for the follow-up. On the US, you I think had talked about possible growth this year over last year, but with the situation now, do you still think you can deliver growth in the US this year?
Yes, Sayan. We've just done one quarter. We have 3 more quarters. So right now, the overall guidance for the year that we had given, at least for now, we are sticking to it, and obviously we are looking forward to delivering that as well.
And I mean, is it more dependent on, of course, on new product, right? So when will we see that momentum of growth from next quarter onwards, or it will be more sort of second half?
No, it will have to be a combination of everything, Sayan, to be honest. So we are not going to deliver growth if there is a 20% price deflation, as you very well will understand. So to that extent, if we have to achieve our overall growth, it will have to come from all the three facets: a normal sort of a price deflation, unit growth, and of course from new products.
Right. And what was the level of price erosion this quarter, and how does that compare to last quarter?
This quarter was 20% in dollar terms. Last quarter, I think it was around 14%, if I remember. I'm not very sure of the last quarter number, but this quarter it was 20%.
Amit, 20% is a very high number. You're talking about year-on-year 20% decline in prices.
I'm talking year-on-year 20% price decline for our portfolio. No, not net of new products. Pure price decline on legacy business, on existing business. Yes. Yes, we did suffer, Sayan, a huge price deflation this quarter.
And is that very product specific, or is it spread across your portfolio? Because this number looks very high.
This is across portfolio, obviously. It is not product specific.
Okay. And how do you think sequentially the momentum should be in your view, based on what you're seeing at this point in the market?
Right. We were, like I said, we were expecting that the price deflation will reduce, but sequentially from 14 we have gone to 20. So, over those 2 quarters. So it's gone the other way around than what we had expected. Now, obviously, we will hope and expect that, it doesn't go beyond this number and in fact starts coming to normal number.
Mm-hmm. Okay. And, a general question on margin. You were talking about margins sort of moving higher in due course. So the question is that what is that dependent on, in the sense that do you have leverage in your India business, or is this going to depend more on, let's say, the US business stabilizing and, growth coming there? And, if you compare the margin for the India business, let's say pre-COVID till now, how is that comparison?
Okay. So, Sayan, increase in margin is dependent on both. One is domestic leverage, obviously, as we mentioned during the previous question. And even on international business, we have identified some, cost rationalizations which could be pretty meaningful, but we are still evaluating that, so we can't really give you really guidance on that. But we understand that, everybody is restructuring their portfolio. We also know what kind of, portfolio we could restructure in international business, and that could lead to some cost optimization in terms of some, a lot to go with manufacturing plant cost optimization as well, linked with that. So we have got some levers there. Now they will take a year to implement because, to do those stuff, it's not that easy. So we have those levers, and we are fully committed to increasing margins, not just as a lip service. So we feel very confident that if you forget this year and you take a 2-year horizon, we would be increasing our margins.
is obviously now very low. So how should we think about the steady state margin for the international business?
I think, see, international, the price erosion which you have seen is obviously like very high this quarter. So I think it also a lot of depends on how the US market kind of responds in the future. If this kind of erosion remains, then obviously the, even whether it has margins will be under question. So I'll refrain from really saying that. Let's see how the US market functions. Otherwise, any kind of guess on what profit margin will have might be a, just a guess.
Okay.
This quarter was really tough. Let's see how it sustains.
Got it. Thanks and all the best. Thank you.
Thank you. The next question is from the line of Aditya Khemka from InCred Portfolio Managers. Please go ahead.
Yeah, thanks for the opportunity. Good evening, everyone. Sandeep sir, from a marketing and sales-driven organization to manufacturing and now CDMO and biosimilars, the journey in the last 4-5 years for Alkem has been quite revolutionary in that sense. Can you talk us through, so these two businesses, which is your India business, which is more branding, selling, marketing, and then the second part of your business, which is manufacturing, contract research, contract development, capital intensity being high. Which direction is Alkem tilting to, and why are we diversifying away from our core competency of marketing, branding, and selling?
Right. Great. Aditya, so first of all, let me start with the latter part. We are not tilting or diversifying. I mean, we are diversifying, but we are not letting go of our core. I would put the question to you. Do you think we are letting go of our core? Do you see us domestic sales slack? I would say no.
No, that's not what I meant. Yeah.
No, what I meant is we have not let go of our core, Aditya. Point number one.
Sure.
Because we understand that is our kind of a core and it's critical. So that remains, and the organization cannot at all think of letting go of, eye from the ball on domestic market. Now, see, CDMO is something which we discussed, but that's still very small, and we have not put any large capex or any marketing or anything of that sort. So that is kind of something which is getting built up, but I will not say that the whole company is geared towards that. Now, Aditya, you understand obviously that the world, including India, is changing. Biotech and biosimilars will be an important part. So you'll have to ultimately kind of take part in that. So biosimilars again is going to get core of what we are doing in the next few years. Yeah, and similarly, so you can't win those markets like biosimilar play without manufacturing of biotech. And we have not been like too aggressive on that. It's like we have not like put like hundreds, we have just put 200 crores on the plant of biotech, and we are like measuring it. We are not going all hog, and not like, if I can say, we are measuring the depth of water with one leg at a time, not with both legs. So just to reiterate, we're not letting go off a core at all, Aditya.
Sure. No, that's not what I meant. I just wanted to understand the diversification perspective, which is well answered by you. Thank you.
More than diversification, Aditya, it's also growth opportunities. I mean, diversification for diversification, I'm not a believer of that, but it's also a matter of growth. Because you see that US market is challenging with small molecules. You need to find other things like biosimilars, and we are a very simple company compared to a lot of other companies. A lot of other companies are doing injectables, inhalation, everything else, but we are not. We are doing oral solids, and now we are saying we are doing, biosimilars. So I would say one of the most focused companies, sir.
Fair enough, Sandeep. And Sandeep, I joined the call a little late. Did you talk about what kind of price increases on a weighted average basis have we taken so far, and how much of the older price inventory was sold in 1Q, and how much of the newer price inventory has been sold in 1Q?
Yeah. As you know, for scheduled product, we had opportunity to go with 10.73%. That's wholesale price index released this time. I think in most of the cases we have gone for it. And you rightly mentioned, actually, impact of that, it has not come fully in this quarter because we had some extra inventory of earlier manufactured or earlier batches. So once it is consumed, and then we are going to have, and obviously in quarter 2, we are going to have entire benefit of price increase. As far as non-scheduled is concerned, so wherever, depending on our competitors' price and all this, it is subject to that. But wherever opportunity is there, we have taken increase there as well.
Right, Rajesh. So thank you for that. On the raw material side, as we understand from what we are noticing in some of the commodity prices, it seems that there is a bit of cool off. Brent has come down and other commodity prices has also seem to be cooling off. So how much of high-priced inventory? One, do you agree with the assessment that spot raw material prices from China, etc., are lower than what they were, let's say, 3 months back? And if that assessment is correct, how much of the older, higher-priced inventory do we have of raw material, and when do we start seeing the reflection of the newer, relatively lower-priced inventory getting consumed in the P&L?
Yeah, you are very right. Actually, prices of API started softening, and as far as high-priced raw material consumption is concerned, I think more or less substantial part we have consumed, and we'll start getting a little bit softened raw material price consumption going forward. So if I have to quantify to a certain extent, I think somewhere close to 80-85% of expensive API is already consumed so far.
Right. One question for Amit. Amit, one of your largest competitors in the US market spoke about product rationalization, letting go of loss-making products, and reducing the product offering to the customers because those products were just not generating profits. And you said 20% price erosion on a portfolio level, whereas in the India business, we have been able to take price increases. I'm sure raw material costs for both the businesses have gone up alike. So in that context, how is the Alkem portfolio going to survive, given that the companies that I'm talking about are in multiples of the size of your business in the US, and yet they are facing a problem of cash flow on that geography and rationalizing portfolio. So right. How do you look at the outlook of your portfolio in the US, and how do you sort of differentiate yourself versus those larger players?
Differentiation, I won't be able to answer, Aditya. It's a generic business commodity market. Of course, we have our USPs and our strategies, but at the end of the day, if a competition has the same product, there's very little differentiation per se. Going back to the original question, we do this exercise always. If there are products within our portfolio which we think are not generating return or investment or margin for that matter, we certainly discontinue or look at reducing them. And in many cases when, like we just discussed, if there is a 20% price deflation, there will be some products which will start getting into the negative area, and we will let go of those businesses. So really, sometimes we get forced out of the market also. Of course, we can keep that business by making losses, but that's not our philosophy. We don't do that. We simply get out of those products. So we do it actively, and sometimes we are forced out as well.
That's a fair point. I mean, if you're not making money, why do the business? So in that context, then, in terms of capacity, would you need additional capacity for your small molecule business in the US for the coming 3 years?
No, I think some time back we had very clearly guided that we have built a capacity for the next 5 to 7 years, and now with very little growth happening on the volume terms, we think that 5 to 7 year still remains the same despite 2 years hence.
Right. One last question, and I think maybe Sandeep can answer. Sir, we are seeing a lot of merger and acquisition activity. I know you get this question every con call. So in terms of deploying capital, you have options. You have an option of putting up a plant or capacity for biosimilar, CDMO, US generics, and you have the other option of buying some brands. I know the pricing may not be, as per what one would ideally want, but at least there is a positive ROI on that business at a certain stage. So have you reassessed your threshold of considering a acquisition in the Indian market, or would you stick with your original parameters of what you consider as value of buying Indian brands and investing in India?
Yeah, Aditya, I think we'll stick to it. So, but let me kind of build on that a little bit, because I know from where you're coming from. So you mentioned domestic business, international, CDMO, etc. But we don't have any capex plan for any of them, which is like significant for the next 2 to 3 years. So there's no question of choice among the three of it. Obviously, first thing is that. And second, we continue to grow our domestic business organically, which is, I think, is a good thing. We continue to outperform. So I don't think we have changed our stand of acquiring something, but that doesn't mean that we never evaluate opportunities. We do look at them, but we kind of, when we hear those valuations from bankers, we kind of stay out. So we are still looking at a few things. If it makes sense, we'll buy, but if it does not make sense, we'll never do it for vanity. We don't want to look good. We want to be good in the long term.
No, I really like discipline in the organization. That has been one of your highlights, and I really appreciate you sticking with it.
Thank you, sir.
Thanks a lot, guys. Thank you for your answers.
Thank you. Before we take the next question, we would like to request participants to limit their questions to one per participant. The next question is from the line of Nikhil Mathur from HDFC Mutual Fund. Please go ahead.
Hi, good evening. My question is on the profitability of the domestic business from a slightly longer term horizon. I'm not looking for answers, numbers here. I very well understand that there could be some gross margin reversal in the near term because of raw material prices cooling. But if I look at the OpEx below gross profit, Alkem works with a MR field force of more than 10,000 now. If I remember correctly from previous con calls, 20-25% is the churn that the company used to indicate. With that kind of a churn, is it possible to increase the PCPM structurally from where the company is today? I am also aware that chronic is ramping up, that can add to the PCPM, but at the same time, there would be some churn that's happening on the acute side. So I'm not too confident or too sure whether the PCPM can improve from where the levels it currently are. And add on top of this, the biosimilars build-up that needs to be done for the next 3-4 years. Aren't we looking at some sort of a peak OPEX to sales ratio or a similar OPEX to sales ratio going forward in the coming 3-4 years?
I'll answer your first question. You have two questions actually. You ask about increase in productivity and then you ask about the OPEX on current 10,000 field force and then how do we address that, correct? So number one is PCPM, obviously when we intend to grow at around 10-11% on a productivity of around 6 lakhs, so which means we are improving our productivity on acute front. Yes, our chronic productivity is at a mid-level, so around 3.5 to 3.7, where there we take little aggressive growth of around 23 to 24%. So our acute therapy continue to outperform the market and thereby increasing the productivity. And we intend to grow chronic by at least 2 to 2.5x of market and therefore, outperforming not only the market but increasing the productivity more than what market increases. So that is what is our objective. So over a period of time, productivity is bound to increase if we sustain our growth levels. Yeah. Because we are not increasing manpower much now. We have done almost 1,000 every year for last 5 years. As our MD also spoke just now that, we don't intend to do much on expansion front except for a few this year, but it is more consolidation and building productivity. I believe last time we answered the same, that one of the growth lever would be increasing the productivity.
Sir, but with a field force of 10,000 and more, your top performing MRs would be prized assets for many other companies. So wouldn't the need to retain them, which would involve that you have to raise salaries of MRs, and if you don't retain the top performing ones, the PCPM hit that you take, because the new ones will take some time to ramp up. Why I'm asking this question is this question is more relevant for Alkem in my view. It's because of the MR base that you operate at versus unlike other companies which are at half or 70% of the MR base that the company is at.
Yeah, so that remains challenge across industries, not specific to Alkem. So retaining team will always be issue, and we have our inherent, that bonding with team, and we have various HR initiatives where, team bonding and retaining the team.
and we are certified as best place to work for last 3 years. So we keep on continuing to see that, our attrition level remains lower than the industry, and thereby retaining people. And we are known in the industry to be one of the best paymaster in terms of incentives, and we are very highly incentive-driven company, and that helps us retaining people. So one is providing the right culture and environment, and second is how do we reward them to the best of the incentive structure in the industry. That too help us to retain people. But yes, nevertheless, this still remains a challenge of retaining people, and we are aware about this.
Yeah, but very clearly PCPM will increase. I don't know why you doubt that. It has to. Yeah. Yeah, and the second question, what is your second question, sir? You asked something. You asked someone R&D biosimilars. Can you repeat your question?
No, I think this answers. I mean that was just a add-on question. PCPM is what my focus was on. I think this helps. Yeah.
Thank you. The next question is from the line of Shrikant from Asian Market Securities. Please go ahead.
Hi, good evening. Thanks for the opportunity. My question is on domestic trade generic industry. So if you can talk about how big trade generic industry is, what has been your market share movement for last 4-5 years? Because last couple of years we have done very good business. So if you can comment on the market share and little bit on the futuristic, how we should look at the trade generic industry growth rate in India.
Yeah, so a lot of questions there. I'll try to answer them.
Thank you.
Market share on trade generics, we cannot really say that because there's no data like you have for prescription business. But I can tell you that we are either number 1 or number 2 in trade generics. That's point number 1. So we are very close number 1 or maybe a number 1. And trade generics is really growing now. It's outperforming the market to a large extent. It's also mentioned in some of the questions we had earlier that a lot of other companies are now entering this. So I think you have got tailwinds. This industry will outperform the normal pharma industry.
Okay. And anything on the market share movement?
No, market share movement I think has only increased because as I said, we are close number 1, if not a number 1. So, and there is no secondary data, no validated like third-party data. So I think whatever market share I tell you might be not very accurate.
Okay. Okay. And one small bookkeeping question is on if you can provide the acute, chronic, and trade generic contribution during the quarter.
8460.
Yeah, Yogesh, why did you?
Yeah, so acute is 84 and chronic is 16% to the domestic business.
The prescription business.
The prescription business. Yeah.
Okay. Okay. And trade generic, any number? Trade generic?
It's close to 20.
Okay.
Right.
Okay.
Yeah.
Thank you very much.
Thank you, sir.
Thank you. The next question is from the line of Vijay Karpe from Shriram Life. Please go ahead.
So thank you for the opportunity. I have 3 questions. The first one is, what has to happen for the price erosion in the US to reduce? That is 1. 2, what kind of ROCs do we enjoy in the US business versus the trade generics and branded generics?
There's a lot of echo over there. Can you repeat your question?
Your voice is cracking.
Yeah, I'll repeat my question. So the first question is, what has to happen for the price erosion in the US to reduce? 1. And the second question is, what kind of ROC do we enjoy in the US business versus the trade generics and branded generics? And the final question is, can you throw some light on the working capital cycle for this quarter and the inventory days as well?
First question I didn't get on the US. Well, price erosion, I said it was 20% for this quarter. It was actually 19% and 1% was volume reduction.
No, my question was what has to happen for this price erosion to reduce?
What has to happen for price erosion to reduce?
I can't really tell you. One of the key issues has been, of course, customer consolidation, but that's not going to change in this quarter. The only thing I can say is that, at some point of time, there'll not be so many offers or people giving so many offers coming through, and therefore that automatically will come down.
Some players getting out.
Manufacturers, that is on our side, that is. Those kind of things will impact. Mr. Dubey, the other questions were for you, ROC and whatever.
As far as ROC on international business is concerned, we have very in single digit, but definitely it is positive single digit, and we are in the process of improving ROC. I think third question, I don't recollect. What was it, your third question?
The working capital cycle, inventory days.
Yeah. So working capital cycle for this quarter, it is 110 days. I'm not talking US, I'm talking on company level, so 110 days. Is it okay?
Thank you so much. Yes, yes. Thank you so much. Best of luck for the rest of the year.
Thank you. The next question is from the line of Prashant Nair from Ambit Capital. Please go ahead.
Yeah, hi. Good evening, everyone. Just a couple of clarifications because I got disconnected in between. So on your margin guidance, if you could just clarify both at the gross and the Ebitda margin line. Did you mention that on Ebitda margin you expect to be north of 18% from next fiscal, but this fiscal you could be a bit short of that number? Is that what you indicated?
Yes, absolutely.
Right. Thanks. And on the gross margin line as well, if you could just give us a general sense of, how margins could progress over the next 2 to 3 years, that would be useful.
We have given guidelines of 59% on gross margin front, and yes, obviously first quarter it is not there. Going forward, we'll try to improve, but I think in immediate future we are going to remain somewhere in 59-60% kind of gross margin.
Okay. And just one last question from me. Can you quantify the expenses you are incurring on the biosimilars, biologics side currently? R&D, any other expenses all put together? What would it be on the P&L?
Yeah. So in biosimilars, we don't have a huge pipeline for regulated markets, and in the regulated markets we have huge CT costs. So we just have one product which we are doing currently for global markets. So the costs are not very high. So R&D and OPEX would be close to 150 crores. 150 for OPEX, that is plant and everything, all other administrative cost, and pure R&D would be close to 100 crores. So it's not significant.
Okay. Cumulatively about 250 is what you're...
You can say that, yes. Yes.
Okay. Thanks a lot. That's it for me.
Thank you. We have the last question in queue from the line of Kunal Dhamesha from Macquarie Capital. Please go ahead.
Yeah, thank you for the opportunity again. Just a couple of basic questions. One, what would be our working capital cycle for the branded India business? Just a ballpark number.
So for ethical business, our working capital days it will be somewhere close to 58 days.
And would it be fair to say that the trade generic would be slightly higher than this?
Yes.
Okay. Okay. And secondly, out of our 3,400 crore gross block, can you just give me a ballpark number of what would be the gross block which is targeting the US market, or
Actually, I think readily I'm not having this figure, but generally we never share our fixed assets utilization on respective business. But Amit, he will be talking to you separately and try to provide some kind of...
Amit Khandelia.
Yeah, Amit Khandelia.
Yeah.
Okay, sure. Thank you.
Thank you. That was the last question. I now hand the conference over to the management for their closing comments.
Thank you everyone for joining the call. If any of your questions are unanswered, you can get in touch with me. Thank you and have a great weekend.
Thank you.
Thank you.
Thank you.
Ladies and gentlemen, on behalf of Motilal Oswal Financial Services Limited, that concludes this conference call for today. Thank you for joining us, and you may now disconnect.